Hello, friends. And this is a room of many great friends of ours and also online. Welcome. I'm Sarah Rosen-Mortel. I have the great honor of serving as the president of the Urban Institute and also to welcome our audience today. We have many of our partners and friends here in the room, and we had over 1,200 registrants online who are joining us now, and I suspect others will be watching us later, so my great appreciation to all of you. Before I jump in, I need to do some housekeeping. The recording and relevant links for today's event will be posted online after the event and emailed to all registrants. If you're looking for the bios of today's speakers, you can find those also on the event page today, and the slides will also be there that will be used later in the program. We will leave some time today at the end of the panel, which will come after the meeting with the former Fed officials, so we will invite Q&A at that point. If you are interested in joining us in that conversation, you can drop your questions and comments in the Q&A box on the Zoom. And if you're here in the room, you can do the old-fashioned thing and raise your hand. We're gathered here today to talk about how we can how our country can navigate a rapidly changing landscape for community and economic development. What will it take for more communities to be investment ready? And how can investing in local growth deliver economic benefits for all of our communities? Today's event is also special and exciting for us at Urban because it's the culmination of work we've been doing for 2 years now to launch the new Center for Local Finance and Growth, which we hope will serve as a nonpartisan knowledge and solutions hub for the community and economic development and mission finance sectors. Its institutions, its investors, its partners, and the policymakers who seek to encourage and flourish it. For decades, Urban has helped the field understand capital flows, the role of CDFIs or community development financial institutions. I have now provided the acronym for anyone who does not know it. We no longer have to say that, CDFIs, for the rest of today. And the rollout and effectiveness of key place-based programs like Opportunity Zones, New Markets Tax Credits, and much more that are central to the sector. This center builds on this long track record of both research and engagement with the field, and it will provide an expanded platform to scale our impact and more nimbly respond to the pressing questions as they emerge without having to go out and seek funding for each new body of work that we want to launch. So I want to say an enormous thanks to our funders for their generous support of the launch of the center and their sustained partnership with Urban, including Bank of America, Capital One, the Kresge Foundation, JP Morgan Chase, and the Robert Wood Johnson Foundation, and the Wells Fargo Foundation. I also want to thank the groups who have been and will continue to provide their wisdom and guidance to help us shape the focus of the center, the agenda, and advise us on the work ahead. And these include practitioners, including the investor community, and many current and former policymakers. I would also like to congratulate my colleague Brett Theodos for this next chapter. Where is he? So I can say congratulations. In his truly unique career dedicated to building opportunity in places around the country. Across Urban, Brett has a wide array of partners in his work and analysis, and a great team who have come together to help us launch the center. You know who you are, but you also know, I hope, how deeply appreciative I am for all of you. And finally, I'd love to just say thanks to the great program we've put on today. It's a terrific lineup, so I'm eager to dive in and get to it. Just so you know what's to follow, we're going to start with a brief framing presentation from Brett about the state of the sector, painting a picture of how capital is distributed across the country, not always reaching all of the places we hope it would, and talk about the role of CDFIs and other mission lenders in helping to increase access to capital, and the ways in which that is and is not yet translating to local economic growth in rural, suburban, and urban communities. I will then be joined by former Reserve Board Governor Randy Quarles and Lael Brainard to join me for a conversation about the evolution of federal place-based policy and what comes next. And then we'll end by a really terrific panel of practitioners hearing about how this whole system ends up landing in place. These are leaders who are navigating these changes at the state and local level in real time, exploring barriers and opportunities they see for place-based investment. So with that, please welcome our new Center Director, Brett Theodos.
Thank you, Sarah. Thanks to our incredible team. Thanks to our funders. Thanks to friends gathered. It is a joy to be here with you all. Indulge me a minute. I started 20 years ago as an RA at the Urban Institute, and I don't despise small beginnings. I don't despise them for me, for our center, and really in the work of revitalizing our communities. We know there is much work ahead. We also know there is great shared strength among the many partners gathered. So let's dig in. The flow of capital is central to the lifeblood of any community. But investment doesn't reach everywhere. We've seen a lack of economic growth. Some places are zooming ahead. Median income in Utah, inflation adjusted, rose 80% over the past 50 years. In contrast, in West Virginia, we have had no income growth above inflation in 2 generations. Investment is strong in growing markets, but weak in others, especially a large section in the middle of the country. I think we know that cities have different economic conditions and trajectories. I'm not sure we've grappled with the fact that there's a 21x differential in place-based investing, mainstream, mission, market, federal investment in the top to the bottom city. Investment is not reaching everywhere because of difficulties in investing in rural places and higher poverty places. And we've seen that with mainstream capital flows. Even on a per capita basis, we see a penalty to being small. And we know the challenges to investing in small and rural places are the difficulty in attracting investors, but also creating a sustainable pipeline, and that those things reinforce each other. Well documented is the challenge of concentrated poverty in our country. Of course, low investment is both chicken and egg, both cause and effect. We know investment is not reaching everywhere, specifically with respect to a hollowing out we're seeing of small business in our context. Small business share of employment has been declining for decades. More recently, small businesses are closing at higher rates than other businesses. And while big firms are growing, small businesses are losing jobs. So that's our problem statement. We do have solutions. We have resources and tools, capacities, institutions, programs, regulations, just to list a few on the screen. Today, in addition to launching our center, we're releasing a major new report, a landscape review on federal place-based policies and programs. Please go read it. Thanks to Arnold Ventures for supporting that work. We document federal place-based housing, community development, economic development, small business spending, including tax expenditures. How have we done? We've done pretty well at growing or maintaining tax credits and incentives. But we've atrophied many appropriated programs. CDBG is now just 1/6 of its inflation-adjusted historical peak. The home program, less than half its former size. Not to mention the current challenge of vital and already appropriated CDFI fund resources that are still frozen. We've seen in the past half decade what catalytic investments into CDFIs from the public sector and from private and philanthropic sources can do in growing the assets and the investment of the CDFI sector. That's led to a diffusion of investments across our country. And we've seen that in the small business space, thanks to tools like the SBA, SSBCI, EDA revolving loan funds, USDA, and others. And so what that adds up to is, well, the picture of mainstream capital looks like this across size of place. CDFI investment capital looks like that. And federal resourcing in these spheres looks like this. And it's a similar picture when we're looking at poverty of place, what mainstream capital is doing, what CDFI investing is doing, and what federal investment is doing. In our report, we document 9 key observations, or we might call them challenges, about federal place-based programs. I'm not going to detail them all here, but we'll point out just a few. That our system is highly specialized and complex and also fractured and small relative to the need. Essentially, we figured out how to put a nice building in a disinvested place, but the true work of community development, let alone economic development, is largely a dream unfulfilled. And we need bigger dreams. We need dreams the size of the Tennessee Valley Authority, the Hoover Dam, and the interstate system, just modernized. For greater impact, we need to bolster these solutions. We need to reduce transaction costs. We need to improve geographic targeting and better incentivize and align impact. We need to coordinate and sustain investment in place, not move on after a project is built. We need greater resources. My research has documented we need between $500 million and $1 billion per census tract or 2, dripped and drabbed over 20 to 30 years. So we have to think both bigger and longer term. We need greater involvement in communities themselves in shaping and participating in investment in their places. There are exciting developments and innovations here. We do need federal action to magnify them. We need to firm up our commitment to CDFIs and the mission finance sector, and we need to help it reach the hardest to reach places, businesses, and projects. We need more robust and modernized set of programmatic tools and regulatory supports, especially, for example, for startup and mainstream and even some high-growth small businesses. We're here to do our part through data and research, insights, through tools, through resources, through dialogue, and we're here to do it in partnership with you. Okay, with that teed up, let's bring up our first panel.
Surprised them. Are we all set? We're here. Excellent. So thank you, Brett, for that challenge. I think there's, safe to say, plenty of work to do. And my great honor now to have a conversation with Lael Brainard and Randy Quarles. Their full bios are online, but I'm going to just spend a moment because I think it's helpful context setting. Lael is currently a distinguished fellow at the McDonough School of Business at Georgetown. She was most recently the 14th director of the National Economic Council at the White House. Previously, as the Fed, she was vice chair, I think, for monetary policy.
It's just vice chair. It's the real vice chair.
That's not what most people think.
There's a story there. And she also drove, as I think many people here know, the interagency process in efforts to create new CRA rules. She also previously was at the Treasury as Undersecretary for International Affairs, and you'll see why I emphasize that, because we have some interesting parallels in careers here. And earlier, she was the White House International Deputy and Sherpa to the G8. At that point, she and I even shared an office in the West Wing, which is fun for me to do. Lael is an economist, Randy is a lawyer. They do occasionally get along together. It's nice to see. He is also the chair and founder of the Sinosure group. We were talking about pronunciation, having served as the board's first vice chair for supervision and chair of the Financial Stability Board. He also served in a variety of senior positions at the Treasury Department in both Bush administrations, including as Undersecretary for Domestic Finance, and previously was a partner at the Carlyle Group. During their tenure together at the Fed, and I suspect throughout their policymaking careers over that long history, each of them have thought deeply about how to drive economic growth in all of our communities across the country, and we're lucky to have them here today to talk to us. So I'm going to start, Randy, with you, and then ask Lael the same question about your observations on what's happening federally. We think of this as being about place-based policy. And what feels new or different right now? OBBA, I think I dropped a B there, but you get it. And what are you expecting we may see in their thinking about this from the current administration?
Well, I think, as everyone here would know, I think the general theme, certainly from the Big Beautiful Bill, is more of an emphasis on incentives rather than government-managed programs. The OBBA, I also dropped a B. It made the low-income housing tax credit permanent. It made the new market tax credit permanent, which is pretty important for creating tax incentives. It has more of the administration's place-based focus, for obvious reasons, has more of a rural emphasis than urban emphasis. So the opportunity zones for rural areas, the basis step up was tripled relative to urban areas, and so I think that emphasis on tax incentives versus government grants. Not that the government grants were completely done away with in the bill, of course, but that greater emphasis on tax incentives and the greater emphasis on rural areas will be a continuing theme in the administration's place-based policies.
Lael, your observations?
Well, first, it's just an honor to be here with two people that I've worked closely with in this agenda. So it's great to be here. And, just kind of stepping back to first principle for just a moment. So community development, we just saw from, it's hard, right? Market incentives alone are not enough to drive a self-sustaining positive cycle of investment in many parts of the country. Disproportionately now, I would say rural, but it's also true in certain counties all over the country, in areas that are even within urban cores. And so that's why mission-based finance and policy are essential. And both are focused, I think, when they're best, on making that market-based incentive for private investment investable. So tax incentives are a good tool because they drive private sector investment, because they make returns sufficient that private sector investment starts to come into an area, and that, more often than not, is more likely to lead to positive growth than, public programs alone. So I think that's why we're all focused on these kinds of incentive programs. And as Randy said, by making the new markets tax credit permanent, that's been a longstanding goal, bipartisan, really important for funding things like schools and rural health centers and other kinds of businesses in underserved communities. Also making opportunity zones permanent. There, I think the track record is a little bit more mixed, but some of the changes that were made, I think, push in the right direction. But there's also, and of course, very important, long-standing goal on the LIHTC tax credits, two very important provisions. They are made permanent and expanded. And as we all know, 95% of affordable housing in America depends on LIHTC, and it is something that mission-based builders use in a very entrepreneurial way to actually develop. So the one confusing piece, I would say, is the CDFI original position was to 90% cut the funds for this program and eliminate all of the staff. And that seems counter to the rural focus. It seems counter to place-based. Luckily, Senator Crapo, Representative Kim led bipartisan letters and had those things reversed. But that was the one piece of the puzzle that didn't really jibe with the rest, in my view.
And I think the Treasury Department has been a voice, as best we can tell from outside, to continue to see investment in these programs, recognizing that, among other things, new markets and those other programs are actually administered by the staff at Treasury who do those things, so it's a little hard. In a shameless promotion moment, I'll also note that the center, one of its recent products was an analysis of the Opportunity Zone program in Ohio. One of the challenges of the program is we don't have great data about how the tax credit is being taken, so it's hard to know what all the results are, but Ohio did report, and Brad and colleagues did close analysis, and I guess I would describe it as trying to understand the Goldilocks places. Governors are having to now make decisions about which communities to designate. They're being lobbied from across the state, and ideally they should find the places where, with the incentive, they will be able to leverage additional investment, but not those places where it would ideally flow in any event. So hopefully that can be helpful advice, and we know a lot of the state governments are looking at that closely.
I would just add that I'd certainly agree with that. In our own state of Utah, we've invested as a family in a few opportunity zone areas that seem to have been selected rather randomly. And with some data and analysis, I think it would be, I think it would be helpful. I mean, it certainly was good for attracting investment to those areas. We just scratched our head a little bit as to why they wanted it there.
And I think in some places it even may have accelerated investment that was happening already in ways that went too fast for the community and wasn't allowing everyone to be able to avoid some of the displacement, et cetera. So hopefully there'll be some wisdom in the next round of selections. So, Lael, why don't we start with you on this? I want to talk a little bit about what you're seeing happening in the banking industry. This sector depends, not entirely, but to a significant extent, on the investment that's driven by banks that are driven, in many cases, by CRA, something you bear the scars of working hard on. We are seeing in the banks a lot of consolidation amongst the smaller institutions, and also a great deal of competition from fintech and non-banks and all kinds of new credit and lending models. How do you think those shifts are going to affect the community development finance system?
So I think when we look at the community bank model, they are disproportionate lenders, particularly in small business, in a lot of these same communities that we're talking about. So, 60% of small business SBA loans still being made by small banks, community banks, 70 to 80% in underserved communities come from small banks or community banks. They also have disproportionate CRE exposures, which are really important to these communities relative to some of the money center large national banks. They do a lot more relationship lending. They're in those communities. They can do a lot more qualitative analysis, whereas a lot of the biggest banks have to operate at a distance using dashboards, using metrics, credit scoring that is not contextualized for the local community. And so these bigger forces, technology is a huge part of it, that's leading to both consolidation of the banking industry so that more and more activity is going to larger size banks, a lot of branch closures, a precipitous pace, I would say, as these mergers and consolidation go on, for all the obvious reasons, that is how they reduce cost. And then we also have a move out of the banking system to fintechs. Fintechs tend to operate with mobile platforms, and so they're not in local communities either. And they are making small business loans, but again, they have to do it based on basic metrics. And so if you look at the satisfaction rates of borrowers, small business borrowers, much higher satisfaction with their local community bank lender, medium satisfaction with the larger banks, and extremely low satisfaction, interestingly, with the fintechs. And so I think the big question is this consolidation trend, technology, serving people more remotely through mobile means that there's a lot fewer people who are invested in that local community and understand it, who are going to be partners to mission finance or really interested in finding ways to invest.
And just, I'm going to turn to you in a second, Randy. To some extent, that challenge that you've just described, a pretty big challenge. Is there any opportunity in these changes as well for these communities, and or ways to mitigate some of those consequences for the region?
So I don't know, Randy can jump in, but I think there are a few things. First, obviously, mission finance organizations are to some degree coming in to fill the gaps, and so providing those incentives and that support is important. So for instance, when I was at the Fed, I did a lot of community development visits. Randy probably did too. They really help you get in touch with how different the experience is of different communities around the country. If you go to even underserved areas of Detroit, there are probably banks in Detroit that have an interest in seeing those communities thrive. But if you go to parts of the Mississippi Delta, or if you go to Pine Ridge Reservation in South Dakota, there is not a branch to be seen anywhere. And so in order to get any local, sort of sources of finance, they have to be very creative, and increasingly they are creating CDFIs and working in partnership, but mission finance has to be a part of it. And then part of it has to be finding a way that fintechs and the big tech players who are increasingly serving these communities need to see the connection between a thriving local community and the success of their own business models, the way that community banks traditionally have.
Randy, thoughts?
Yeah, I would certainly agree with all of the challenges and the opportunities that Lael described. I do think that community banks are, the major source of the type of finance we're talking about, but they're also being significantly challenged currently, and the consolidation that creates some of these problems is also necessary for them to survive. Just the burden of cost of banking technology, the increased burden of regulation, even in Trump 2.0. I mean, there are many community banks that are not going to last over the course of the next decade if they aren't allowed to consolidate. So allowing that consolidation is probably necessary in order to continue the existence of that ecosystem of banks that's important for supporting this sort of investment. But closing a branch in a local area has a psychological and financial consequence that's undeniable. But I do think that solidifying the strength of that community banking cohort is an opportunity for this, if we can figure out then how to ensure that support is directed broadly to the whole footprint of the newly consolidated community bank.
So one of the things that influences all of this is CRA, and I think at least for the moment, we're back in the regime of the rules we've had since you and I were in the White House, which is more years than we want to admit. And so what do you see happening in its relevance? How is it going to Is anybody likely to try to reopen the regs at some point? How does with the shift in fintech and other types of banking, how is that going to affect the impact of CRA? Randy, do you want to start?
Yeah, I don't expect there to be sort of a big push to push the CRA itself in a different direction during this administration. To the extent that there are tweaks to the CRA rules, I would expect it to be sort of increasing the size, the cutoff for small and intermediate-sized banks, sort of simpler exams, making it easier to comply with for smaller and simpler companies. The new administration's CRA push, which is not necessarily irrational, is less going to be you must lend to this category of borrowers, as opposed to you must not lend to this category of borrowers. When I was at the Fed, there was something of a to-do about all of the large banks saying we're not going to fund fossil fuel. We're not going to lend for fossil fuel exploration and development. Got a call from the senator from Alaska who said, "Look, this is crippling the low-income communities, Native American communities that rely on this operation in Alaska. You have to make them lend. Do it under the CRA." And I said, I'm not going to do that. I'm not going to tell them they can't lend, and I'm not going to tell them they must lend. I'm a libertarian. You've got the wrong guy. So, but that I think is the CRA shift, if you will, the CRA focus of the administration, debanking as opposed to tweaking the regulations or the legislation of the CRA itself.
But can I push on one thing? There is a strong emphasis of asking the mainstream institutions to invest more in rural places, but a little bit of a trick because that's not really where they draw their deposits from. So the CRA isn't as powerful a driver in that regard.
No, that was one of the things that Lael's efforts sought to fix, which I think is appropriate to fix. That doesn't make me terribly popular in my home state of Utah because of all the banks that are headquartered there and therefore lend enormous amounts under the CRA to Utah. But that doesn't really make any sense, and and it's obviously something to address. But the CRA, as it now stands and as it's likely to remain for the next several years, is not a tool to address that issue.
Lael, your observations?
Yeah, so I think, just reminding ourselves, CRA was really smart the way it was put together, right? The fundamental insight of CRA is that banks should lend back to the communities where they're gathering deposits and that they should serve all members of their communities with an emphasis on not excluding low and moderate income communities in particular. That's the basic thrust of the original CRA. And it is true, we haven't been able to update it since really for 30 years, right? So why update it? Why is it important? Because as we were talking about earlier, branch closures are taking place at a precipitous rate and have been now for many years, driven by technology and the desire to, or the need to lower costs, right? Consolidation, putting in new technology, serving these areas more through apps and less through physical presence. But the CRA is almost all around branches. And so assessments are really around your branch area. If you're moving away from a branch-based model, then the question is, well, how do we assess whether you're reinvesting back into that community where you were collecting deposits if we don't actually track that? And there's no assessment of that. And I think that's the conundrum that remains in front of us. Is the CRA going to be relevant as the banking industry increasingly goes to that kind of mobile model? The only other thing I think that's really important to point out, particularly in rural areas where we see the most branch closures, I mean, Randy and I saw this all the time when we were approving these mergers, it was kind of heartbreaking, but there was really no great answer in these rural areas. Those are also some of the areas that are most challenged in terms of getting access to broadband. And so are they being well served by mobile apps? In some cases, maybe not even that. So I think it's a real conundrum. And that was the major, I think, thrust of the CRA rewrite that the banks, understandably wanted to push back against because it changed the nature of their obligations. But as we look at the bigger picture, with fintechs taking a bigger share and the nature of banking just fundamentally changing, you really have to ask, should there be some kind of commensurate type of expectation of a broader set of businesses, because banks are kind of being asked to do something that other entities who they compete with are not. And that big question really hasn't been addressed at all.
Yeah, obviously that branch-based focus made perfect sense in the 70s when the CRA was first put in place, because how else would you gather deposits? There was no other way to do it than having a branch there. So that, it made perfect sense. And like so much in Washington, it has continued to make the same sense that it
50 years later.
So the one window on this, though, that we are starting to see, and it doesn't really reach to the fintechs, but it brings a new class of maybe potential investors to the table, is the press in rural areas to build data centers and the consequences for both labor market and economic development, housing markets and other things of that push. I got invited to 3 things about data center invitations while I opened my email this morning. It is the topic du jour. And it is starting to open a conversation about what kind of investment and what kind of impact sudden large-scale investment has on rural communities, whether it's sustainable or not, how it affects costs, et cetera. So that could be one opening of this conversation. I want to maybe in this case start a little differently than I thought, but with our libertarian. The Biden administration articulated, Lael was a critical piece of this, I suspect, what many of us refer to as a modern industrial policy, right? Thinking about energy, chips, infrastructure as segments of our economy that we cannot be competitive without some core capacity onshore. And also, clearly, the pandemic taught us how vulnerable we were when our supply chains were dependent on overseas delivery from countries that were not always our allies. President Trump makes no secret of his desire to take a similar managed approach to the economy here. And in both cases, that's a pretty big shift from what would have been bipartisan liberal conservative consensus about what good economic policy looked like. I'm curious how you think that set of conversations might affect local investment generally as we think about place-based. Are there risks there, opportunities there? You want to start us, Randy?
My views are not going to be surprising on that, and not entirely consonant with the current administration. I wear it as a badge of honor that I am the only Federal Reserve governor that Rand Paul ever voted to confirm. I think that both efforts, are misguided. I think that history has shown us that efforts to manage the economy centrally are beyond the capacity of man, even with AI. There's not enough, there's too much information to assimilate. There's not enough information generated within sort of either a mercantilist or a redistributionist effort to manage the economy centrally. I think that and I think that the effect of that on place-based investment, you see it with the tariff policy. I think they affect each other sort of integrally, and it's the way that sort of high tariff policy has worked in each of the three main ways we've had of it in American history. The McKinley tariff policy began as building a big, beautiful wall around the country, and over the course of, and it immediately had, dramatic political effects. The Republicans immediately lost the midterm elections. Benjamin Harrison lost the presidential election 2 years later. And by the time you got to the McKinley administration, it had evolved from we're building a big, beautiful wall around the country to we're using these tariffs to negotiate reciprocal reductions. Same thing happened with the Smoot-Hawley tariffs. And then the State Department spent the next 12 years negotiating reciprocal reductions of all of these tariffs because of the reciprocal tariffs on rural places. Farmers complained bitterly about the reciprocal tariffs. It affected U.S. manufacturers, U.S. industries that depended on imported inputs, and we have seen that develop sort of rather rapidly over the course of 1 year of the Trump administration's policy. To the extent one discerns the policy, but it appears to have evolved.
There was a plan.
It appears to have evolved relatively rapidly from we're building a big, beautiful wall to precisely because of the place-based consequences of the tariffs, we're going to negotiate reciprocal reductions in tariffs. So even though we're ending up with a sort of a higher tariff burden, and that's not something that I think is ultimately sensible for the economy, it's not nearly as high as people thought that it would be, and is being shaped in part because of these particularly rural consequences.
Lael?
Yeah, well, I certainly see the same effects on, I think, unintentional, both tariff policies, actually some of the immigration policies too. They have had place-based effects, although that was not the design. Right. And so we have tariffs raising fertilizer costs and closing foreign markets to American farmers. At the same time, they have a disproportionately foreign-born workforce, and their costs are going up. And so we've seen loads of stories about crops rotting in the field. So there can be quite negative consequences if these things are not very well thought through. I mean, generally speaking, I probably agree with Randy more than not in that industrial policy, to the extent that we engage in it, should be very targeted, should be mostly through the tax code so that it's providing incentives that the private sector can respond to, not picking winners and losers. And it should really address market failures, areas where the market is not going to provide enough capital, for instance, in advanced semiconductor manufacturing, where you had government subsidies in other countries, making it very difficult for those massive capital investments to take place any longer in the US on a purely market-based model. It really required adding in some tax incentives. But when we do those kinds of things, there is an opportunity to add place-based additional incentives. And so, for instance, the energy communities bonus, the low-income communities bonus, those make the tax credits even more profitable in areas that are underinvested but have real potential to take on some of these new industries. So I'm a fan of doing that where possible. And the final thing I'll just say is you mentioned AI data centers, which are huge and increasingly an important force in not only in rural America, they're in suburban America, they're in many parts of the country. The administration is reportedly thinking about some kind of quid pro quos where the companies that are investing in these communities would make some investments in the communities, potentially build out the transmission lines, take on the entire cost of the build out. Those are things we thought a lot about as well. We wrote an executive order, particularly when it is for building data centers using public lands for transmission lines. And I think this current administration actually has built that out. I think the question that the CRA raises is just, if you have an executive order, you might have a great announcement, but you actually need an infrastructure to make sure that those investments don't raise electricity costs, don't harm the water supply, do result in local jobs, do result in investment. And so there actually, unfortunately, does need to be a bit more of an accountability mechanism than the mere announcement effect an executive order would deliver.
So one thing I want to just mention as a focus perhaps of some of our work ahead, this whole conversation about growth and sectors that are competitive are even more relevant to governors and even county executives and mayors who are looking at, in some cases, the natural advantages that different communities have for different types of industry, different types of growth. And CDFIs and the mission investment sector as a whole can play a role in reinforcing those ecosystems. More mayors, everybody wants a very large CDFI in the area. Of course, it needs capital to be able to invest. So what are the best models that we can find and grow and spread from place to place that is organic to the local advantages in industrial sectors, market-driven, but also maybe helps to accelerate the opportunities in those places. I think it's a mission for us. Last question is we need to end on hope. This is good to everyone's mental health, among other things. Brett's slide deck talked about challenges of place-based poverty. We've raised more of them here. But there are also a robust infrastructure here that when problems have gotten stuck, whether it was the PPP program during the first Trump administration, when it was the Biden administration looking to find ways to drive the clean energy investment cycle to all of our communities, people look to the sector as part of the solution. So what are the things that you think are opportunities for this sector to contribute to making sure our economy serves all of our communities in the period ahead? Lael, you look like you're itching. You can go first.
Well, I will say that when I have met with local communities, there are always some incredibly entrepreneurial people who have managed to use a combination of federal tax credits and state and local tax credits, philanthropy, and local business, and put together viable projects. So, we have an incredibly innovative economy generally, and a lot of people who have entrepreneurial drive and great ideas. And I think as long as we continue to innovate at the policy level and make sure that some of these incentives are in place, because these investments truly can't make market hurdles on their own. But as long as there's some commitment from the federal and state governments, along with philanthropists, I think you actually do see some very exciting models at the local level.
Andy?
Yeah, I myself, I think that the shift towards an emphasis on creating tax incentives and market incentives from a predominantly grant-based approach is very encouraging. I think that's a source of optimism that it will produce more than, as referred to in the opening section, more than a very nice building in a disadvantaged community, as opposed to reinvigorating a community. It's sort of a twist on the place-based investment focus. As just a particular example of something we were recently involved with, we were anchor backers of something called Redemption Bank in Utah, which was the first black-owned bank in a long time, and the first one ever in the Intermountain West, and the first one that was not located in a distressed community, with the idea being that by creating that, by locating that institution in a place like Utah, the Utah economic miracle was also referenced in the
Pride of place.
Exactly. but a place where, that has the highest return on banking investment in the country, that has, a very strong and dynamic economy, and that would allow that bank to create a base of strength from which it could, because of its purpose, because of its mission, then expand to serve banking deserts between Houston and Los Angeles. So it was definitely the place in which it was located was key to the concept behind it. But it was a twist on the way we typically think about place-based investment. So I think that the opportunity for models like that to grow and develop is really quite exciting.
I will say the one downside to the reliance on tax credits is they're typically not the only layer of subsidy in a deal, and the complexity of having program requirements in 7 different types of subsidy. People talk often about the brain damage that is incurred by people all over our audience in putting these deals together. We do need to find scalable models that can be replicated more readily, that are not so bespoke, and better understand these transactions so that we can make them move faster and more quickly and have stronger infrastructure behind them. Again, a nice topic for us to tackle. Well, I'm uniquely proud that we had a conversation with 2 former Fed governors, and no one talked about Fed independence, which is probably all you get asked about as you walk through the halls. But more importantly, it's great evidence that the tenure of the governors at the Fed does involve deep thinking about not just the global economy, but also place-based economy and the centrality of this work. We're really grateful to have had you. Thanks for being with us.
Thank you. One related to what you said, however, to your last comment, I would only say that it was Lael and I disagreed about many things when we were at the Fed together. But I did. But it was a place where it was all about the analysis. I like to think of us as the Ginsburg and Scalia of our time at the Fed.
And who's who?
And it's a special place because of that ability for people of many different views to collaborate on coming to both technocratic and economically sensible solutions.
Well, I'm glad to hear that, and I would say we hope we create a similar special place. Lael introduced the idea to me of inviting you to join us for this dialogue, and perhaps evidence of your past positive engagement together. And I think the topic we're talking about here today is one in which all parts of the country and policymakers across the ideological spectrum share an interest in economic growth for all our communities. So I hope this is a place where we can replicate that spirit. With that, I'm going to turn the stage over to Dennis Price, who's the CEO of Impact Alpha, and we will go from the macro policy dialogue to talking about how these issues play out in place. Thank you guys very much. Please join me.
Okay. Hi, everyone. Or we say at Impact Alpha, greetings, agents of impact. Close readers will know the reference. But there's certainly many agents of impact in this room and up on stage. So thrilled to be with you here today. I've been following one agent of Impact's work for about a decade now, Brett, who for me was a journalist cheat code with all the analysis and the data, I think particularly around opportunity zones. So thrilled to see the launch of the center. So congratulations to you and Sarah and the Urban Institute. I think it promises to be an essential resource for the moment. As capital markets and federal policy grow more uncertain, Urban has stayed focused on what matters, grounding debate in evidence, elevating what works on the ground, and helping communities get practical about what they can do next. And I think it's important to say this out loud, too. The challenges facing communities around the country are not new. Divestment, affordability, pressures, uneven access to capital, these didn't appear overnight. What is new, perhaps, is the pace of change driven by shifting policy at the federal level, tightening subsidies, of course, and technologies like AI and the advance of fintech, as you guys shared. That pace creates real risk, but also creates opportunity. Communities that have been building through adversity for decades are often best positioned to figure out what comes next. That's what we're here to discuss today, how local leaders are doing the work right now, turning coordination, creativity, and capital into real outcomes for residents, small businesses, and neighborhoods. With that, let me introduce the panelists. Laura Bruner, President and CEO of the Port of Greater Cincinnati Development Authority. For more than a decade, Laura has braided and blended capital and finance to fix the broken real estate market in Cincinnati in order to increase home ownership and grow manufacturing jobs. Welcome, Laura.
Thank you.
And Bradford Davey, former Chief of Staff for Cleveland Mayor Justin Bibb. In City Hall, Bradford led the mayoral operations and drove enterprise execution across departments behind an ambitious agenda, including the design and delivery of Cleveland's first 10-year strategic plan to modernize operations and service delivery. Welcome, Bradford. And Jessica Hayes, the Senior Vice President of Public Policy for Invest Detroit. From her role at Invest Detroit, Jennifer has led the creation of the Michigan CDFI Coalition and led advocacy efforts that have resulted in hundreds of millions for Michigan's CDFI and venture ecosystems. Welcome.
Thank you.
And Ryan Makamalan. Ryan in Memphis. Apologies if I butchered your name. Ryan in Memphis, Vice President of Venture Development at Startco, and he's also a founder who's helped bring medical device companies from FDA clearance to market. He co-leads Lasting Machine Ventures and the Innovation Exchange Coalition, where he focuses on building real pathways for founders and communities through place-based investment in cross-border and international innovation. So welcome. Let's jump in with Jennifer. Jennifer, in Detroit, what roles have CDFIs played in local place-based investment? And what have they done that traditional finance doesn't do?
Sure. Well, I would say an incredibly important role in Detroit. After decades of disinvestment, we're incredibly fortunate that we have about 18 CDFIs that are active in the city, and they range everywhere from small micro lenders all the way to we have an MDI bank and some credit unions that are incredibly active. And so without them, I don't think we would see the activity and the neighborhood reinvestment we're seeing today. We also have a Detroit CDFI coalition where we advocate together, but more importantly, we build programs together. So when we see a gap in the market, we come together and build initiatives and offer new loan products to do that. But I think more importantly, we do that in partnership with our city government, our state government, and with the corporate and foundation community as well. So it's really built on partnership. And without that, I can't imagine we'd see today what we have in the past 10 years.
Say more about the coalition.
Sure.
Because it's more recent and new.
Yeah.
What prompted the collaboration, and what has it unlocked that individuals can't do alone?
It's a great question. So for us, we have two CDFIs in the state of Michigan. The Detroit CDFI Coalition was launched over 10 years ago because we had such a concentration in the city of Detroit. And then I would say about 4 years ago, coming through COVID, when SSBCI 2.0 was getting launched, we reached out to our other CDFI partners across the state. We have about 55 CDFIs in Michigan. And we started working with them through recommendations we wanted to make to our state economic development agency about small business lending for SSBCI programming. And out of that, we made a formal recommendation. And then we realized, hey, we're all dealing with a lot of the same challenges around the state. And so working together, we came up with the idea of trying to launch a state CDFI fund in Michigan. So we put a proposal together. We were incredibly fortunate that the Speaker of the House at the time was from Detroit. He knew who CDFIs were and what we did. And we went off on a great advocacy kind of strategy, and we were able to secure $75 million and launch the state CDFI fund. Since then, we've gotten a total of $100 million over the last 4 years. The incredible thing about it is it's grant capital. So everyone, all the CDFIs in Michigan get a grant. 80% goes towards loan capital, 10% for operating, 10% for technical assistance services. And you can use it for anything you're certified to do. The other great thing is it's through a formula. So the dollars come in hand within 3 to 4 months after that budget is proposed. So it's quick. And we really looked kind of what the federal CDFI fund was doing during COVID and getting dollars out quickly into the ecosystem. And I have to say, we have an incredible group of state legislators who didn't know who we were 5 years ago, to now we probably have about 10 champions that year over year, like, what do we do next? What are we doing now? And so we're continuing to work on that with them.
Just break the structure of the fund down a bit. There was the initial 75, so where did that come from, and then how are you able to leverage that?
Yeah, so we're able to get a really big initial source of funding because during COVID, Michigan, because of the ARPA funding, we had quite a bit of surplus. So for a few years, we had $2 to $3 billion in extra funding. And so we actually, it's general fund dollars, but there was extra general fund dollars because the ARPA money was given to special programming. So it's been all general fund year over year, but we've been able to bring it above the line in what we call the state LEO and NEDC budget, which is our state economic development agency. So we're not considered a one-time program anymore. It's considered part of our economic development strategy. But we do have to advocate every year to ensure that funding comes year over year. But this year, one of our priorities is to see if we can make it a permanent program and actually pass a statute that makes it state law, which would make it easier to get funding year over year.
Can you just give us one example of what that money is being used for?
Sure. So I know for us at Invest Detroit, we are putting it directly into our neighborhood work. So whether it's supporting a small business or a mixed-use project, it goes right into our lending capital to support our neighborhood work. Yep. And also we are growing our technical assistance programming. So we've brought on 2 team members that are coaching our small businesses, getting them capital ready, but then also doing post-capital TA as well. So both of those have benefited from this grant program.
Excellent. Yeah. Excellent. Let's bring in Bradford. Give us some more of a city level view. From your perspective in Cleveland, what does it mean to get a place investment ready? And what are the pieces you have to put in place before outside capital can come in?
Sure. Well, first, good afternoon, everyone, and thank you and congratulations to the Urban Institute on the launch of the Center for Local Finance and Growth. I know that it will continue the Urban Institute's legacy of arming practitioners like us with actionable insights. Investment ready for a city fundamentally means that you can walk into the marketplace with confidence and credibility and say, we have a plan, we have a pipeline of investable projects, and that we have a local funding engine to help make those projects come true. So for a city to truly be investment ready, I think there's a couple of things that communities can do. The first is creating, evangelizing, and really ruthlessly and vigorously protecting priority projects. In city halls, that's going to show up like your government affairs team really focusing on state capital budgets. It may be building good relationships with your state and your federal delegation, and it may be having honest and tough conversations with local partners about projects that are important, but don't meet that high bar of, this is our priority project. I think the second is that we have to become our own engine. Look no further than Urban Institute's own research on capital flows, and you'll see that, Cleveland sits amongst the top of charts on mission-aligned capital and federal capital attraction. That is proof that just having deep alignment with Washington is not going to get it done. So that means that we're going to need to take a deal posture, a confident posture that says we too are going to find ways to make our money durable and put it inside of projects that we believe in. And so in Cleveland, that has meant taking a hard look at how we have deployed TIFs, typically on a project-by-project basis, and expanding that.
Just define TIFs.
Yeah, so tax incremental financing, right? We're going to take appreciation of buildings and real estate. We're going to say we're going to take the appreciation of that and then reinvest it. For us, that works on projects, but when you do big, audacious things that meet the scale of our problems, we don't have enough cash, so we have to think about that as a district, right? We need to draw an amoeba and say everything inside of this is happening. The same is true for things like new community authorities, which are small taxing jurisdictions in Ohio, where you can raise user fees. For us, this is our ability to say, we are going to create durable streams of capital that we are going to unilaterally deploy to the things that matter the most to us. And I think for cities like Cleveland, where we are willing to take big bets, but money isn't flowing, it's our way of creating that sort of deal posture that mission-aligned capital and private capital want to see.
Are there examples? You said unilaterally, having your own capital to put into projects, but where you've taken that capital and partnered with the private sector or with some federal funds that have come in?
If I do nothing else today, it will be to remind everyone here that Cleveland is a coastal city. We sit on America's north coast on the shores of Lake Erie. Our goal is to connect our riverfront, which divides our city east and west, to our downtown, and then our downtown to our lakefront. To do that, we need a lot of infrastructure dollars. And so rather than do project TIFs, say we really want a high-end hotel that overlooks our waterfront, we do, if you're interested. If we are going to get those at scale, we are going to have to develop some public infrastructure needs and subordinate some capital in a real way. And so we anticipate a TIF district that spans our urban core and our waterfronts that can produce something in the realm of $2 to $7 billion over our project term. And we're matching that with state and federal money. And our hope is that with those two sources, we can say, our lakefront is open for business.
We've talked the earlier panels and comments talked about the sort of whiplash that's been going on over the last few years. How do you, as a city, as a local entity, maintain sort of durability through those cycles? Keep your head on straight.
Yeah, any strategy or plan that is predicated on values-based federal alignment is not a strategy, it's a bet. And so, again, just doubling down on this idea that communities, large or small, rural or urban, if we can create durable streams of our own capital that are evergreened, and sometimes that's going to be at city halls, and sometimes that's going to be with our partners or with our foundations or our quasi-government institutions, we have to find ways to create local engines that we control and that we can deploy in a way that makes sense on our own.
Great, thank you. Laura, in Cincinnati, what market failure are you taking on, and why is a public development authority best positioned to take it on in your case?
Thank you very much. Thank you, Brett, for the invitation to come, and it's nice to see friends from different organizations. One of my investors there in the back at Kresge Foundation, Aaron, and my current strategic planning consultant, Laura Blatchford. So I've got a lot invested here in this group. So we are, there are 50 of us at the Port Authority. So all of us are employees of the Port Authority, which is a quasi-governmental formed by our city and county. We manage our county land bank. We manage a nonprofit that is a CDE. And we have a community development enterprise. Is that entity? Yes, thank you. Thank you. It's the organization that can apply for and deploy new market tax credits. And we also have an affordable housing nonprofit. So we've got various different entities. We're a development finance agency. And we've got two areas of focus, or two ways to think about this. We are aggregating capital from multiple sources and we are deploying it in broken real estate. So our goal is to bring unproductive real estate back to highest and best use, ultimately back in the private sector, where it will pay taxes and return investment back into our communities. So the return on investment is never to us. We lose money on every single thing we do, but the municipalities, townships, the county itself will benefit from increased taxes, capital investment, increased residents. We're very much focused on good jobs and homeownership as two areas of focus. So your question is, why are we best positioned? And I think it really is just a recognition that to solve these problems right now, we have to have lots of different tools. And a public agency is well equipped to attract grants. We've received $80 million in federal grants in the last 3 years. And, $80 million of state grants, $12 million of federal grants, and $12 million of city and county grants. So that's one layer, because the grants are what we need to lose money. And then we're attracting loans that we have to repay. So you have to have, if you're going to lose money in everything you do, you have to have both financing. Somebody has to loan you the money, hopefully at a good impact, social impact rate. And then you need the subsidy in order to invest.
You mentioned good jobs, home ownership, and I guess manufacturing jobs fit in good jobs category. How do you set goals like that? There's all sorts of different goals you can set as investing locally. How do you set goals and then sort of work backwards to the type of finance you need for that?
So those are the two primary areas where we're setting goals. On returning industrial zoned land, you've got a corridor here from Detroit and Cleveland and Cincinnati. We've all benefited. We've all been major manufacturing hubs in the past. We've lost 140,000 manufacturing jobs in our county since 1967. And that leaves you with a lot of industrial zone land that's contaminated and obsolete. And old manufacturing was vertical on small parcels, and new manufacturing wants horizontal. So we need big parcels. So we have to assemble. So it's super expensive, but it yields. Our promise is that we will only sell our property to manufacturers that will deliver 16 jobs per acre at an average of $65,000 annual wage. So that's our measurement there. And we've set an initial goal of 500 acres of industrial land to return back into that productive use. And on the homeownership side, we haven't really quantified it as much, set particular goals. We own over 700 vacant lots in the county right now, so we've got plenty of inventory. We have returned 200 homes back into productive use in the last 12 years. Probably the majority of those, 75% of them, have been renovations of vacant, neglected homes that we were able to acquire through the land bank, and the rest were new construction on vacant properties.
What's next for the port? You've 200. Sorry, 200.
We've done 200 homes so far. There are a few things. Closure. Laurel, go do this. We have a few different initiatives. In the last year, we've taken over the management of this large CDC that is the CDE, called Uptown Consortium. That is the geography where our universities and hospitals sit. And so we're working now on a strategic plan for an innovation district there, which really requires the collaboration of those institutions so we can redevelop land that we own in that area. And so that's one major initiative. The other is really focusing on 49 acres of manufacturing industrial land that we own immediately to the west of downtown Cincinnati, which was the hub of our old manufacturing. And then we are in the process right now of raising an additional $20 million for the acquisition of investor-owned real estate to take properties back from rental into homeownership.
Okay. All right. Well, keep us posted on that. One other plug. Rachel Riley wrote an awesome case study of the port for Impact Alpha. So check it out, and we'll do the follow-up version together. Ryan, you're working to unlock and enable entrepreneurship or entrepreneurial talent where it exists in all communities. When you're thinking about entrepreneurship pipeline in underserved communities, where do you start? Where do you go?
Yeah, so typically we would start with, like really looking at that community and what resources they've been given in the past or currently have, and trying to really map out the interventions that's already existing. Most of the time there isn't any real intervention in, the most rural ecosystems or, been massively underserved communities. So we would typically go in and try to identify community leaders first so we can gain trust in the community. So, that could be civic leaders, church leaders, whoever it may be, and usually use them as our way of really integrating into the community. So we'll invite them in and we'll start doing these different workshops, which one of our core beliefs is that most entrepreneurial support kind of systems leave out the ones who don't even identify as entrepreneurs up front. And it's usually more problem solving, mindset creating. So we'll do these community workshops where it's like, hey, there's a million problems in the world. Here's these structured workshops that teaches you how to truly be a problem solver. So we'll start there, and that really starts sparking interest because they'll apply those principles to their own problems. But then really through the workshop, like, oh, if I actually fix this, there's a million other people with this problem. And that's how you really start, a very underserved community, is by that inspirational entrepreneurship. And then we start leading, and it's like, oh, that's interesting. Now, what if we do customer discovery around that? How do we canvas out this business? And now you're layering on tools, education, and inspiration, and that's really where you start. Sometimes the downfall is that it doesn't move as fast as some of our grant metrics would like to have, and so that's where it gets very intricate on measuring the right impact. But I'm sure we're going to talk more about the details, but that's usually how we start, and then start rolling it from there. Typically we see more funding instruments come alive because it's like we went from 0 to 50 people from a community that we didn't even know had entrepreneurship. That's a story we have to tell.
So churches, community centers, you're providing additional support and training because they're community hubs. In terms of financing and investment or grants, where are you? At what point do you bring in investment money to support these businesses?
So in that model, we would start with something very small. Like they make it to the next workshop, it'll be like $1,500 to do an experiment, or we'll have like some kind of a platform tool that we have access to. It's like, hey, this is actually how you use HubSpot or some kind of tool like that. So we started layering on that amount of money, which from a general entrepreneurial perspective doesn't seem like much, but if you didn't even think you were an entrepreneur, that's a significant signal that first off the community believes in you. So like the value of the money is it's how you place it more so than the size of it. So that's usually where it starts, and then that's where it leads into the bigger entrepreneurial support organizations that have $25,000 grants, accelerators. So we're de-risking the communities that typically don't have access to the already available ecosystem support, and that's where they start getting the bigger checks through the accelerators, and that way we're not competing and opening up a whole new thing. It's building a systems approach to helping all the communities.
And you're in Memphis, but you are also doing this work and making connections internationally. Say more about that.
Yeah, so through some of the work that's federally funded and funded with other partner nations, we're doing very similar things from underserved communities, from all over the Caribbean through LATAM, and then thinking about how do you pair those markets with our markets. It's pretty much the same strategy, but it's a different clientele. So you're looking at startups, or even it could be a restaurant that's in the Caribbean who's like, it'd be really interesting to open up something, say in Memphis, so how do you support that and structure it? We're doing it through a very programmatic, method where we're working with sometimes the embassies or the ministries of economy in those countries and our local leaders to come up with investment instruments, pilot opportunities to integrate them in. The strategy behind it is that certain countries peer better in certain states and cities. So it's kind of the magic behind figuring out where this particular culture will fit in better. So it's not just finance. It's like really thinking about the human-centered approach to it.
And just give us a flavor for how many folks you've worked with over the years and what
Yeah, I mean, we've been at least 10 different nations across the Western Hemisphere and in Europe. Right now, we have about 40 founders in our portfolio, and that could be a variety of things where it's like we had one who did a manufacturing partnership in Armenia because they were more willing to do one-off, intricate medical devices there, and it was actually a good way to stimulate their economy. It was good for our founders here, so that's one example. And another one was an interesting medical device company that expanded their device into the Caribbean. And a lot of those markets are usually underlooked from a technology perspective. Because from us as medical founders, we would just basically go into the bigger markets and don't think about the smaller ones. But it doesn't mean that they shouldn't get those technologies. So the platform really thinks through those kind of logistics and making, again, very human-centered approach on different communities in that way.
Great. Okay, now I'm going to back it out to the group a bit. This week in Impact Hour, this week or last week, possibly last week, we covered the Kensington Corridor Trust in Philadelphia, which I imagine a lot of folks know about. But the idea was, how, and the question I think they're asking, and imagine you guys are asking too, is how do you do community development, because you want the community to develop and get wealthier, but do it without displacing folks, and making sure that happens. You're thinking through that from the beginning. Oftentimes, collaborating with private investors or competing with private investors. How do you think about balancing development with displacement?
I'm happy to.
Homeownership
Yeah,
might be one.
No, good.
I would say for us in Detroit, I think when we're doing the work in the neighborhoods, we're holding community events. We're really focused on what do they care about, what do they want to see, what are their housing needs. Is there a need for a coffee shop or a bakery? And so I think for us, we really focused on the community-driven solutions, and we're really partners in doing that. And a lot of the capital that is coming to the neighborhoods in Detroit is through alternative sources. Not that we don't have traditional, financiers that are helping us, but you're really seeing, I think, the mission-focused folks in the neighborhoods first and foremost, and really trying to meet the community needs. And I think that really helps drive a lot of the investment that you're seeing in the work that we're doing.
Yeah, one of the things that we did in that scenario, because it's a lot of places in the Southeast is maybe not as many venture funds, or the checks are too high for the stage, is we started working with a lot of the bigger corporations and broker pilots, because we need to keep them by helping them actually make money and having a deeper impact in the community. And it was easier for us to structure and help design pilots and get that funded as a good experiment. And then that would help them stay more local, and that, of course, that revenue traction helped unlock bigger capital. So we really had to take a very hands-on approach to help keeping founders there.
It's also important that we're courageous about describing what a lack of growth looks like. Certainly on the other side of this coin is communities that are deeply suffering with jobs that don't sustain families. So one of the things that I think all of us have to do is be really clear about the outcomes that we're hoping to see, whether that is the creation of homes that folks can afford that will be in neighborhoods that appreciate, or for us, the creation of family-sustaining jobs. The creation of family-sustaining jobs for us is the cornerstone of our growth strategy. And so, if we can achieve that, certainly the upside will befit the approach.
So obviously, I think that's one of the most important goals, right? And I will say that every single home we have owned is in a low to moderate Black and brown neighborhood. We're working in the red line neighborhoods. So that's an incredible area of focus. They have experienced high vacancies, so there's a lot of opportunity to bring more people in. And so the goal is to make sure that we're careful about that and that there isn't too much of an imbalance. And we've done that in a couple ways. One of them is to focus, as you said, on home ownership. And our purchase of rental properties that have been owned by investors is a really important tool, because in many of these neighborhoods, these big investors have purchased the average $150,000 starter home and converted them to rental.
You have a stat too in Cincinnati, right?
There are over 4,000 homes in our county owned by 10 institutional investors, which is a staggering number. And they say they only own 1% of the homes in the country. But if you look at homes under 200,000 and you look in these particular neighborhoods, sometimes they own 50% of the street. So we're very conscientious on focusing on purchasing those and converting them to home ownership. One of the things that we realized a few years ago, we are literally taking houses apart and putting them back together, so they're going to last for another 100 years. And so we're delivering a very high quality product at a loss. And so we were developing people that were following us, looking at what we were doing, and we put houses in the market and they'd sell really fast. Well, the people that are able to move that fast aren't necessarily the ones from the neighborhood. And so we started working with the realtors. We were previously listing the houses internally, but we hired the realtors, which is an African American real estate association, as our realtors. And we started sharing with them specific addresses of properties that we're working on, properties that are going to be ready in 2 months, properties that are going to be ready in 2 weeks, with pictures to give them enough time to build a following and get people pre-qualified. So when the house goes on the market, there's not just everyone has an equal chance, or more people have an equal chance.
Very intentional coordination with
Yes.
local partners. We're going to have a Q&A session beginning in a few minutes. So get your questions ready. I think some folks have submitted questions already. And we've talked about some of this, but just given the current environment, if you were to design, and maybe you are already designing to do this work with less federal support, what does that look like for your projects?
I mean, obviously, if you took it all away, and for us, the biggest impact would be home and CDBG. It would, make a big difference, and we'd have to rely on our state and local grants. We continue to look for more impact investing loans, but it's harder to get those in grants. So we would have to slow the pace of the home ownership work we're doing if all the federal money went away. But the good news, the promising thing to me is that home ownership seems to be the one thing that everybody cares about right now. And so I'm, cautiously optimistic that that won't be the case.
I just also realized we didn't talk about your use of the municipal bond market. Could you say how you're tapping that?
Well, I'll just give you the one statistic then. When we bought 194 homes 4 years ago from one of these specific bad landlords, we bid at auction against 12 other institutional investors, won the bid, issued $16.5 million of bonds for the acquisition of those homes, and that's what we're doing now again with this other $20 million tranche.
Got it. That's where that came from. Others in how you think about less federal funding?
Yeah, I mean, for me, if we had no grants and no federal funding in that scenario, really having these more community-driven economic support organizations would be interesting, where it's groups of founders and people like that that are either donating or getting corporates to come in and help fund events, things like that. Which this happens already, but we would have to double down on that. And then the other side is really leveraging crowdfunding a lot more from an investment instrument into the founders, because then the whole community can invest in their own founders. And these tools are already there in existence. They're just not marketed or branded that way, but we would have to rely heavily on that without the federal funding.
Yeah, and I think the one thing that I would add, through our CDFI coalitions in Michigan, I think over the last year especially, we've really learned that, we have some CDFIs that are heavily reliant on federal programming and some that aren't as much. And I think we've really been doing a lot of conversations about increasing our advocacy, but really thinking about diversifying where we're getting our capital. So one thing that we're also advocating for this year is trying to launch our own loan fund. So we're asking for a seed grant from our state legislature to help us launch a fund, and working to try to launch like a $50 million fund in partnership with some of our foundations and capital partners, so that we have a fund that's owned and managed by our coalition, but that our members can apply for. So for long-term, low-cost debt that's flexible, it's just another place for us to go for debt to support our program. So hopefully we're successful, but that is a way that we're trying to think about different opportunities, so we're not so reliant, on the federal government.
Yeah, we talked a little bit about tools today, and I'll certainly leave it to the brilliant researchers at Urban to opine on which ones are most effective in moments like these. I think I would encourage municipalities to exercise something that all of us personally and professionally need to do, which is a bit of self-reflection. More than ever, we are going to need to build enduring sort of A1 partnerships with our institutions and our partners to deliver with speed and fidelity, and that requires high trust. And so cities actively need to build these sort of enduring relationships so that we can deliver this cash through whatever tools and mechanisms are available to us during that day.
Great. Okay, let's open it up for questions. Does anyone right here? Sorry. Yeah.
Hi there. I was really struck by Brett's maps where the counties that were receiving fewer dollars. Research we're doing at the Federal Reserve Bank of New York shows that in most of those instances, those are also places that have real challenges on the health front. They're lower life expectancy, higher level of chronic disease, more deaths of despair. And in many cases, there are also places that are experiencing extreme weather. And so they're harder to insure, their insurance costs are going up. Are any of you thinking about business models that try to bring all of those players together? So CRA-motivated banks, CDFIs, health payers, insurers that are trying to manage risk.
I'm happy to start. I would say in Michigan, we are just starting those conversations because we're starting to experience that, especially in rural Michigan. We're seeing, our healthcare system really hit really hard. So a lot of our CDFIs are not in the healthcare space. Some of them are, but I think we're starting to look at that and how do we play a role in that in Michigan, especially in our northern and rural areas. So I would say we're starting to lean into that, but I think it's a growing area for the CDFI community, at least in Michigan.
We're having conversations locally with our children's hospital and a foundation about getting the foundation to understand that housing is so critical to health and trying to tie those together. I think appealing to foundations that might be focused on education or healthcare and understanding that that ties back to housing, that there are threads for all of this.
I like that question too, because it acknowledges that community struggling it affects a broader set of institutions than just the local folks, and there's other pots of money and interest there. Any other questions?
First of all, fantastic panel. My question is related to, other than the great panel, Tig McClory from Boston. My questions, other than being on the panel together, right, and talking about great place-based strategies, have you also collaborated, right, across regions, right? Because a lot of the themes that you've talked about today are reoccurring, right? And wondering, are there opportunities where you could look at each other as a co-opetition? Because I'd imagine in some cases there's a little bit of competition, but what sort of opportunities for innovation and collaboration do you maybe see or could
I've
see?
had, just last week, Cleveland Port Authority's new CEO came to visit with me with 6 staff and 4 board members to learn about what we're doing. Based on what he learned, he visited Cincinnati last year with the Lincoln Institute of Land Policy's trip to Cincinnati. We hosted one of their convenings, and he came and participated in that, and then said, I want to go back to bring more of my people down here. I've worked closely with other members inside of Cleveland, both in city government, and then they put together a $50 million fund focused on industrial development out of the city, and then spun that off into another entity. I've given that CEO every single thing we have about our industrial strategy. I've been, that's why I've been with a number of you at different organizations across the country, bringing people together. So I think there's a great willingness to collaborate and understand and learn.
One of the greatest challenges that we have is industrialization, as Laura pointed out before. We have 3,000 acres of underutilized and underserved industrial land. Our goal is to transform 1,000 of those acres with 25,000 family-sustaining jobs. The $50 million fund, we're hoping to raise to $100 million. But regardless of how much money we raise and how many proppers we turn, there is a real need for our communities to work with our state governments to talk about what brownfield revitalization really looks like. It's one of those places of great pragmatic overlap between the federal sort of vision and alignment to reshore and our deep entrenched problem, vexing problem of needing to put these tracks back to productive use. And so absolutely opportunities for us to collaborate both locally and at the state.
And I would just add, there's obviously always a lot of fun competition between Michigan and Ohio for very good reasons. But I would say we also, I think, share a lot of information with each other because we have a lot of similar economies. So I know we've made lots of visits to Cleveland and Cincinnati and done some things from investor choice perspective and other CDFIs in Michigan. But I think the other thing that's really exciting that I'm a part of is, and with the support of OFN, there are CDFI coalitions that are developing all over the country. And so we actually have a network of CDFI coalitions that we meet quarterly. We're sharing, how do you create a coalition? What kind of work are you doing? What kind of state policies are you working on? Sharing actual statutory language. And so that is something we're hoping that will grow because it really creates a community and almost an army of people that are doing this every day and learning from each other. So I think that's one way the CDFI community can get even stronger and then learn from each other in different states. So those are two things that I think I'm really seeing right now.
Yeah, and for me, we last year we hosted I think 10 different founders in Detroit, and like we haven't done that together, but we work with the same entities, investment firms and accelerators in Detroit. So we brought Memphis founders that could take advantage of their market dynamics. That we brought 4 international founders from 4 different countries, and kind of did the same thing. So there's so much collaboration, especially if you're doing it intentional. As somebody had mentioned, like sometimes it could appear to be competitive, but for the founders and the ecosystem, as long as they're matched right, it's really not competitive. It's just additive to both ecosystems and the founder, which is what we tried to do in Detroit.
And I think the only thing I would add is I think the one thing, I've been in the CDFI community now for 8 years, and I think one of my favorite things is, there isn't a lot of competition. There's a lot of cooperation. And I think without that, you aren't going to have strong communities. I mean, like I said before, we co-lend together, we build programs together, we support each other. And I think without that, Detroit and Michigan would not be as successful as we are from a CDFI and community-based perspective. And I call a lot of them friends, which I think is a big part of the work that we all do.
At Impact Alpha, we cover the impact investment community, which is diverse, and it's family office money, most of whom live in places. It's foundations, whether it's their program-related investments or increasingly from their endowments. Those folks are on the hunt and in demand for impactful projects and impactful investments, and you all are supplying them. And I wonder how you've found success if you've found success tapping investors from that community or leveraging incentives, perhaps at the local level, Bradford, leveraging like opportunity zone incentives to attract folks to your community.
Yeah, it's a work in progress, and I think we've been, at least in Cleveland, been pretty public about our audacious and ambitious goals around our waterfront, and so we have taken that to mean, it's time for us to operate in the same deal posture, I used that word earlier, as our private sector colleagues, and so we are around the country meeting everyone from traditional financial, C-suite to mission-aligned investors, and trying to work through the same sort of processes you would expect in any other pitch meeting. And so, hopefully, when we're celebrating the 5 or 10 year anniversary of the center, you'll be able to ask that question again, and we'll be able to run a playbook.
Yeah, I think the only thing I would add is I think in Michigan, we're finding not only the CDFIs coming together, but our foundation community has really stepped up to support us, but they're also encouraging us to work together to leverage funding better. And so forcing us to, not always apply individually, apply collectively. And so we're really taking that to heart, and we're also getting asked to do that from a local government standpoint and a state funding standpoint. So we're really trying to collaborate more on whether it's programming or funding ask. But I think you see it really well in Detroit as well. When we launched the Strategic Neighborhood Fund, Invest Detroit was the fiduciary for that. We had a local unit of government, a philanthropy, corporate foundations really come together and raise tons and tons of money to support neighborhood, community-driven development. And that partnership, without all three of those folks being at the table, we never would have been able to do what we did. So I think partnership is, I think, another key message to take away from today is it takes all of us and working together to do this work. It's hard work, so.
Any final question? Oh, over here.
I know. Uh-oh.
I can't not ask a question. So many of my favorite people on the panel. So, I love this panel because you have all in your own ways been very successful in building your sort of own local capital ecosystem. Florida 2.0 is never going to be enough, but you've been remarkably successful. And with the disruptions at the federal level, people are very hungry for how do we do this? How do we build our local system? So I'd love to hear any advice about what you think has worked and what has not worked. And then I would also like you to answer, a lot of federal policy, we look at local actors as folks who are implementers, and I'd be interested to hear your advice for federal policy people as to how to shift that into enablers, right? Shifting you into a role of enabling your local policy environment, your local funding system, as opposed to just implementing something that's built at the federal level. So any advice you have on either one?
Okay.
Yeah, you
You
start
that one.
Hey, Garen.
Yeah.
Look, discipline is so important. And I am speaking from an administrative position, right? We're talking about the executive branch of a municipality who's got, rate limited factors, right? Time, cash, all sorts of constraints. Discipline is incredibly important. And so I think where we have seen real success in Cleveland and where we're starting to see some momentum is we've been disciplined about what is really important to us. That started at the beginning of the term, laying out what were gravestone priorities, what were the things that were going to be legacy items for this administration, and being incredibly dogged about protecting those. Sometimes that doesn't show up in the most friendly of ways, right? It's traditional politicking in local places, which is the kinds of stuff you don't talk about at forums like this. But really, to be successful, I think it's required that municipalities become really disciplined about what's important and express that discipline to everyone, from their investors to their federal and local delegations.
And I think in Michigan, so when we had the Detroit CDFI Coalition already existing and had been working together for a long time when we launched the Michigan CDFI Coalition. But when we first brought our CDFIs from around the state together to work together, there was a lot of people that didn't trust us, or we were still building those relationships. And I think being transparent, being honest, and having a common goal and getting that first success behind you and doing it together really helps build that trust. And so now, we advocate together. We are doing DC Hill visits tomorrow. We're here tomorrow together. We share common goals. And when I build coalitions and work with folks, I always remember you're never going to get 100% of what you want at the end of the day. But if we all walk away with 80%, it's a pretty big win, and it's an even bigger win for the community. So I think it's a lot of transparency, a lot of tough conversations, but also I think just a lot of getting some wins behind you and getting momentum really helps get people bought in and then committed to the work long term. But I think that partnerships and that trust building is a big part of getting coalitions and things successful, and people staying committed to the work.
I would say I agree with everything you've said, but one of the other elements of success is taking initiative and taking risk.
Yes, yes.
No, you need both.
You
have to have lots of external partners, but you have to stop just all looking at each other. Somebody has to actually set the goal, have the discipline, and then get really creative. And tying in your comment about the federal money, we've used EPA money for a specific project, like as part of an economic development project, not just in the abstract clearing up things that might not get used again for 20 years. That's important too, but it also, you can take those same programs and grants and the loan revolving loan fund money that we've got and put it into current projects that are going to yield a manufacturing company in 2 years. So it's maybe taking some of the old programs and using them in different ways.
Okay, I think we didn't get to our speed round. Well, maybe we took it to the reception, but we're out of time. Thank you all. Thank you, Brett. Thank you, Sarah. Thank you to the Urban Institute. I think what is clear is that despite the sort of disruptions almost all around us, communities are still building, and you all are still leading. And the challenge for investors and policymakers is showing up in a way that's worthy of this work. So thank you all for joining.
Thank you, good job.